Imagine waking up on the first day of every month and seeing money deposited into your account without clocking in, without driving for Uber, without selling products online, and without working overtime. For many Americans, that sounds like a dream. But for dividend investors, it's a very real financial strategy. Today, we're going to break down how a $100,000 dividend portfolio can potentially generate monthly income, what stocks investors often use, and why dividend investing has become one of the most popular wealth-building strategies in the United States. If you've ever wanted your money to start working harder than you do, this video is for you. Let's start with the basics. A dividend is a portion of a company's profits that gets distributed to shareholders. When you own shares of dividend-paying companies, you're not just hoping the stock price rises, you're also receiving cash.
Now let's talk about the magic number, $100,000. While it may seem like a huge amount of money, many Americans gradually build investment portfolios through a combination of 401k contributions, Roth IRA accounts, brokerage investments, and consistent monthly investing. Once that portfolio reaches $100,000, the income potential starts becoming more noticeable. The exact amount depends on the portfolio's dividend yield. Yield is simply the annual dividend payment divided by the value of the investment. For example, if a portfolio generates a 4% dividend yield, a $100,000 investment could produce approximately $4,000 per year in dividend income. That's about $333 per month on average. If the yield is 5%, the annual income could rise to around $5,000, or roughly $416 per month. Well, this is where many investors make a critical mistake. They chase the highest dividend yields they can find. A stock offering a 12% or 15% dividend yield might look attractive on paper, but extremely high yields often signal underlying problems. Sometimes the company is struggling financially, and the dividend may eventually be reduced or eliminated. Smart dividend investors focus on quality businesses with strong cash flow, sustainable payouts, and long-term growth potential rather than simply pursuing the biggest yield available. Many successful dividend portfolios include a mix of dividend aristocrats, blue-chip companies, real estate investment trusts, commonly known as REITs, and dividend-focused ETFs. Dividend aristocrats are companies that have increased their dividend payments for decades. These businesses often demonstrate resilience during economic downturns and provide investors with a growing income stream over time. REITs can also play an important role because they are required to distribute a large portion of their earnings to shareholders, making them attractive for income-focused investors.
Another powerful concept is dividend reinvestment. Instead of spending the dividend payments immediately, many investors reinvest them into additional shares. This creates a compounding effect. The more shares you own, the more dividends you receive. Those dividends purchase even more shares, which generate even more dividends. Over years and decades, this snowball effect can dramatically increase portfolio value and income. It's one of the reasons legendary investors often emphasize patience and long-term thinking. Let's imagine two investors. Investor A receives dividends and spends every dollar. Investor B reinvests every dividend payment back into the portfolio. After 10 or 20 years, Investor B often ends up with significantly more shares, a larger portfolio balance, and a much higher monthly income stream. The difference isn't necessarily stock selection. It's the power of compounding working quietly in the background year after year. Taxes are another important consideration. Depending on the type of account and the investor's situation, dividend income may...
One question people often ask is whether a $100,000 dividend portfolio can provide income every single month. The answer is yes, but usually through portfolio design rather than relying on a single stock. Since many companies pay dividends quarterly on different schedules, investors can own multiple dividend-paying investments that distribute cash during different months of the year. Some investors also include monthly paying investments to create a more consistent cash flow pattern. The key takeaway is that dividend investing is not a get-rich-quick scheme. It's a long-term wealth-building strategy. The goal isn't just generating income today. It's creating an asset base that can continue paying you for years or even decades. Every share you own becomes a small financial employee working on your behalf 24 hours a day, 7 days a week. So, can a $100,000 dividend portfolio pay monthly income? Absolutely. Whether it's a few $100s per month or more depends on the portfolio's yield, diversification, risk level, and long-term strategy. The real opportunity lies in building a portfolio of high-quality, income-producing assets and allowing time, consistency, and compounding to do the heavy lifting. The earlier you start, the more powerful the results can become. Remember, financial freedom isn't